Today, we're going over a big one that credit card companies don't want you thinking too hard about: APRs. You might see it on your credit card statements. You've probably heard people talk about it. You've definitely heard about it on commercials, but still, you probably don't know what it really means, or you just really never understood them. But that's all going to change. In less than 10 minutes, I'm going to go over what an APR is, how it works, how to avoid falling into the APR trap, and some smart strategies to manage your credit cards wisely. So what is APR? APR stands for annual percentage rate. Essentially, it's the price you pay if you don't pay off your credit card balance in full by the first due date. Imagine you borrow $100 from a friend and they're like, sure, I'll lend you the money, of course, and you only have to pay me $20 a month. But for every month that you don't pay me in full, there's a $5 interest charge. That $5, that's APR. It used to surprise me how many clients I used to work with on credit card debt that knew they had APRs and knew they were paying interest, but just didn't really know how much of their actual payment was going towards APR or how it really worked at all. But then I realized, is that really shocking? That's what credit card companies want. That's what banks want. They don't really want you to understand they're robbing you blind. They want to make it so confusing, and they want to make it seem like it's such a hard process to understand. Let's break it down with a real example. Say you have a credit card balance of $2,000. Your APR is 25%. Your bank says, don't worry, just pay the minimum of $50 a month. That seems doable, right? But this is the part that gets you and you don't even realize. When you make a payment, part of it goes to interest first, and then the rest of it goes towards the principal, the original amount you borrowed. In this case, the $2,000. If you're making the minimum payment, most of it is likely going towards interest, leaving your balance barely touch. I want to show you what it looks like to be paying down $2,000 at 25% for the first year. Yes, you will be paying down this $2,000 for longer than a year. So I'm just going to show you the first year. This is what it looks like. Your balance is $2,000. Your minimum payment is $50. That gets subtracted from your balance immediately. So now your new balance is $1,950, and then they're going to charge you $41.67 for not having paid in full. So now, how much has gone to your interest? $8.33. Your new balance is now $1,991.67. Then you pay $50. Your balance becomes $1,941.67. Your new interest is $41.49, and only $8.51 has gone towards your principal. Now your new balance with the new interest charge of $41.49 is $1,983.16. Look at month 2. You've paid $100 at this point, and it hasn't even amounted to $17 towards your interest. You might wonder, how do they even come up with that $41? What you have to understand is the 25% is an annual percentage rate. It's what they're going to charge you for the whole year. So what they do is take that 25% and they divide it by 12, which comes to 2.08. So they're going to take that and apply it to the balance each month. I want you to look at this chart, and I want you to really understand that they're charging interest to the first balance, not the new balance. So to get the $41.67, they didn't charge the 2% interest to the $1,950. They charged it to the $2,000. And then to get the $41.49, they charged it to the $1,991 balance, not the $1,941 balance. Let's look at month 10. At this point, you've paid $500 in payments. So you borrowed $2,000 and you've paid $500 towards that $2,000. And just to keep in perspective, you've been paying this down for a year at this point, almost a year at this point, and your balance hasn't even been reduced by $100. That's why only making the minimum payments will keep you in debt for years. And for this specific debt, the $2,000 at 25%, you'll be paying this off for 7 years and 3 months. And you'll have paid a total of $4,334. So you borrowed $2,000, let's say for a TV, okay? And it ended up costing you over $4,000. Is this only crazy to me? This is how I think about it. If I walk into a store and I see a TV for $2,000, right? And I walk up and I'm like, I want it. And they're like, it's a great choice. The sticker price is $2,000, but we want to let you know, you're going to put it on your credit card and you're going to have a 25% interest fee. It's going to take you 7 years to pay off this TV, okay? And then it's going to end up costing you $4,334. So even though the sticker price is $2,000, you'll end up paying like $4,300. But it's a great TV. Oh, and don't forget, it's going to take like 7 years to pay off. Just want to make sure that's clear. That TV better be making my dinner every night. So while paying the minimum sounds tempting, right? It's a small amount. You got it. But as you see, your balance starts to rack up interest. Your interest gets added to your balance and it gets out of control real fast. And the part that they don't tell you about is that you end up paying interest on your interest. Let me show you. Let's use month 2 as an example. Remember, you paid the $50. They applied the $41.49 interest fee to your balance, which they calculated using the 1991 balance, which had the interest from the previous month. And that is how credit card companies make their money. Now, for most people, you're not going to stop at that $2,000. You're going to be putting other purchases like gas and groceries and your Starbucks run on this credit card. But let's say you just wait for another big purchase and you add a $700 purchase to this credit card. Let's say you make this purchase 4 months later when your balance is $1947. Don't think for 1 second that you're only going to be paying that $40 interest fee. No, now you're going to be paying that 2% interest on that $1947 plus the $700. So now that is $2647. You add that 2% interest charge, and now your interest fee is $55. And the rest of these numbers are going up as well. The minute your balance goes up, so does your interest. That's just how it works. And then it becomes a cycle and it's really hard to break and it's really hard to catch up to. Some of the common mistakes I see people make are thinking that APR interest charges are only applied to missed payments. No, they are applied anytime you do not pay your balance in full. So each month that your balance is not zero, you will have an APR interest charge. Another one is believing that minimum payments help you stay on top of your debt. They barely cover the interest. So your debt is going to be sticking around for a long time and not knowing your APR. Listen, if you don't know what you're paying, you don't know that that $2,000 is actually costing you $4,334. And when that happens, it doesn't allow for you to make a smart repayment plan. It just keeps you in this cycle because you don't really know what's going on. So you think it's okay. And I know calculating your interest payments or trying to find out what you're going to pay may feel like you need to be a mathematician. But the thing is that now there's APR calculators on the internet and you can just go to the website, plug in your numbers. It'll not only tell you what you're paying and what your interest will end up being, but it can also give you a repayment plan. So in the description below, I'm going to give you the link to 2 of my favorite calculators. And if you have multiple credit cards, put them all in there. And it'll give you a plan on the smartest way and the best way to repay these debts that saves you the most money. Now, if you want to avoid paying interest at all, always pay your balance in full if you can. Use a credit card with a 0% introductory APR. And if you already have high interest debt, consider a balance transfer to a 0 APR credit card. If you are subscribed to my channel, if you watch my videos at all, you know that I love this strategy. Snowball method, avalanche method, I use them. I like them for debts that I can't transfer to a 0% APR card. But if you can do this, do it immediately. Immediately. The amount of money you will save is in the thousands. And the best part about it is that you won't have to make these huge monthly payments to catch up. You can make small monthly payments with this strategy because you don't have an interest charge. Watch this video and you'll understand why this is such a great strategy. Or you can watch this video and see how I did it for a client and saved her like $8,000. But let's recap. APR is the cost of borrowing money. Avoid it by paying your balance in full, using 0 APR credit cards, or doing a transfer balance to a 0 APR credit card. Be strategic with your credit cards. Only keep 2 credit cards active in your rotation. there's really no need to have more than that. That's when things get convoluted. You start missing payments. You forgot you used this card for that or this card for that. Just my suggestion is have the max 2 credit cards that you're using actively at a time. Apply for new ones when it makes sense. So when your 0 APR introductory period is about to come up, apply for a new credit card. It will not hurt your credit. I promise you, it will not hurt your credit. And never ever close old accounts. So once you're done using this card or that card because the 0 APR period ended, do not close those accounts. Leave those accounts open. Cut that card, destroy that card, never use that card again, but do not close that account. And I'm going to be making a video next week about why you should never close these accounts. It will help your credit score so much. And it'll also help you get other loans or get other credit cards. I'm going to explain it all in the next video. At the end of the day, try to follow these tips so that you can stay out of the APR trap. And do not forget to check out the links in the description and use these APR calculators to find out what you are paying. And listen, people don't usually see the breakdown of how interest is really hurting you. And it's never explained this in depth. So share this video with someone who could benefit. Your cousin, your friend, your sister. Just share it with someone that is really struggling with credit card debt. See you in the next video.